If you've glanced at the news lately, you've probably heard the same explanation over and over again. Inflation is happening because of global conflicts. Sounds reasonable, doesn't it? Higher oil prices, supply chain disruptions, political instability. Case closed. It's a neat story. Simple enough to fit into a 30-second news segment or a social media post. Most people hear it, shrug, and move on. But here's the kicker. That explanation only tells a tiny piece of a much bigger story. Because if today's inflation were caused solely by recent global events, one uncomfortable question immediately pops up. Why has inflation remained stubbornly above target for years? Long before the latest headlines dominated the news cycle, prices had already been drifting higher. Groceries, housing, insurance, healthcare, everyday expenses quietly became more expensive, month after month. That suggests something deeper has been happening beneath the surface. To understand why, we need to look at inflation the way the people running America's monetary system do, not the way headlines present it. Most people follow the Consumer Price Index, or CPI, because that's the number constantly quoted in the media. But inside the Federal Reserve, another measurement carries far more weight. It's called the Personal Consumption Expenditures Index, better known as PCE. Think of it as the Fed's own scoreboard. It's the benchmark policymakers monitor when deciding whether inflation is under control or whether they need to step in. Their long-term objective? Around 2% annual inflation. Not 0, not 5, right around 2. That target isn't just an academic number tucked away in an economics textbook. It quietly influences almost every financial decision affecting your life. Mortgage rates, car loans, business investments, savings accounts, retirement planning, even the future purchasing power of the cash sitting in your wallet. When inflation consistently drifts above that level, borrowing becomes more expensive, businesses face greater uncertainty, and households feel the squeeze, even if they can't immediately explain why. And that's exactly where today's conversation becomes interesting. Because inflation wasn't always this unpredictable. For decades, it behaved almost like a pendulum. Sometimes it swung a little too high, sometimes it dipped a little too low, but sooner or later, it always seemed to settle back toward the middle. Most people barely noticed. Life simply carried on, which naturally raises another question. If inflation used to return to normal so consistently, what's different now? Was the economy simply more stable back then? Or was someone quietly keeping the entire system balanced behind the scenes? Because once you start asking that question, you begin to realize that inflation isn't just about rising prices. It's about understanding who controls the money, how that control works, and why maintaining stability has become far more difficult than most people realize. Most people imagine the Federal Reserve as if it were just another government department sitting in Washington, quietly making decisions behind closed doors. But that's not really how it works. In fact, the Federal Reserve isn't a single building, a single person, or even a single bank. It's an entire system. Think of it like the central nervous system of America's financial world. Millions of businesses, banks, investors, and households make their own decisions every day, yet they're all connected by one institution that influences the cost of money itself. And the most powerful tool in its toolkit isn't a printing press. It's interest rates. Imagine money behaving like any other product. When something becomes cheap, people usually want more of it. When it becomes expensive, demand naturally slows. Borrowing money works exactly the same way. When interest rates are low, mortgages become more affordable. Businesses find it easier to expand. Families are more willing to finance a car, renovate a home, or finally start that small business they've been talking about. Money begins moving faster through the economy. That's great for growth. But here's the catch. If too many people are borrowing and spending at the same time, demand can begin growing faster than the economy's ability to produce goods and services. Shops can't restock shelves quickly enough. Factories struggle to keep up with new orders. Employers compete for workers, pushing wages higher. Eventually, businesses start raising prices, not because they're suddenly greedy, but because demand has outpaced supply. That's when inflation starts gathering momentum. Now flip the situation. Suppose inflation refuses to slow down. The Federal Reserve has one obvious response: raise interest rates. Suddenly, borrowing becomes more expensive. A mortgage payment jumps. Business loans cost more. Credit card balances become far less attractive. People naturally think twice before spending. Companies delay expansion. Investors become more cautious. Little by little, the economy begins cooling down. That's exactly what the Federal Reserve wants during periods of persistent inflation. Not because it wants people to struggle, but because slowing demand is often the quickest way to stop prices from rising even faster. It's a delicate balancing act. Raise rates too slowly, and inflation may become deeply rooted in the economy. Raise them too aggressively, and economic growth can stall. Jobs may disappear, businesses may cut investment, consumers pull back even further. Finding that balance is incredibly difficult. And here's the bit most headlines leave out. Interest rates don't fix inflation overnight. They're more like steering a giant cargo ship than driving a sports car. Every adjustment takes time before its full effect ripples through the economy. That's why today's inflation isn't simply the result of one event or one decision. It's the outcome of countless choices, made over many years, finally catching up with each other. And once you understand that, another question becomes impossible to ignore. If raising interest rates slows inflation, then why did inflation become so powerful in the first place? Because to answer that, we need to go back to a moment when the world changed almost overnight. If interest rates are designed to cool inflation, then another question naturally follows. Why did inflation become so difficult to control in the first place? To answer that, we need to rewind to one of the most extraordinary moments in modern economic history, when the global economy suddenly came to a standstill. Businesses closed their doors, flights were grounded, restaurants sat empty, millions of people were told to stay home. Almost overnight, spending slowed dramatically, companies lost revenue, and unemployment surged at a pace few economists had ever witnessed. The economy wasn't simply slowing down. For a brief moment, it felt as if someone had pressed the pause button on the entire financial system. Faced with that kind of crisis, governments and central banks had a choice: do nothing and risk a deep economic collapse, or step in and keep money moving until the economy could recover. They chose the second option. Governments introduced emergency support programs. Businesses received financial assistance. Households were sent relief payments. Central banks reduced interest rates to historically low levels, making borrowing easier than it had been in years. The goal wasn't to create inflation. The goal was survival, keeping families afloat, helping employers keep staff on the payroll, giving businesses enough breathing room to make it through an incredibly uncertain period. For a while, those emergency measures did exactly what they were intended to do. Financial markets stabilized, confidence slowly returned, consumers began spending again. Companies reopened, economic activity gradually picked up. But here's where the story takes an unexpected turn. The money that helped rescue the economy didn't simply disappear once the crisis eased. Low borrowing costs remained. Large amounts of money continued circulating through the financial system. At the same time, global supply chains were still recovering. Factories weren't operating at full capacity. Shipping delays stretched for weeks. Raw materials became harder to source. In other words, demand recovered much faster than supply. More money was chasing fewer goods. And when that happens, prices almost always begin moving in one direction: up. This wasn't the result of a single policy or a single event. It was the consequence of several powerful forces colliding at the same time. Emergency stimulus, historically low interest rates, supply shortages, strong consumer demand, each factor amplified the next, creating an environment where inflation became far more persistent than many expected. And once inflation starts feeding on itself, bringing it back under control becomes one of the most difficult challenges any central bank can face. Because there was another tool quietly being used behind the scenes, a tool that rarely makes newspaper headlines, yet has enormous influence over the financial system. It's called quantitative easing. Not in happiness, may completely change the way you think about money. Quantitative easing. It sounds like one of those complicated financial terms that belongs in an economics textbook, but the idea behind it is surprisingly simple. Imagine a town where businesses desperately need money to keep operating. Banks have become cautious. People aren't borrowing. Companies stop investing. The entire economy begins slowing down. Now imagine someone opens the floodgates and allows far more money to start flowing through that town. That's the basic idea behind quantitative easing, often shortened to QE. Rather than handing cash directly to every citizen, a central bank purchases large amounts of financial assets, primarily government bonds, from banks and other financial institutions. In return, those institutions receive fresh money that can be used to lend, invest, or support economic activity. Think of it like adding water to a dry river. The goal isn't simply to create more water, it's to get the river flowing again. When more money moves through the financial system, borrowing usually becomes easier. Businesses find it less expensive to raise capital. Investors have more cash available. Banks become more willing to lend. Economic activity begins picking up. During periods of severe financial stress, that can prevent an economy from slipping into a much deeper recession. And that's exactly why central banks around the world have used quantitative easing during major crises. Not because it's a magic solution, but because extraordinary circumstances sometimes require extraordinary tools. However, every powerful tool comes with trade-offs. The more money that enters the financial system, the greater the possibility that spending begins growing faster than production. If businesses cannot produce enough goods and services to meet that demand, prices naturally begin moving higher. That's where the real debate begins. Some economists argue that quantitative easing helped prevent a financial disaster. Others believe keeping those policies in place for too long contributed to the inflation people are experiencing today. The truth is that both arguments contain important lessons. QE can provide stability during periods of crisis. But it also requires careful timing, clear communication, and eventually a plan to reduce support once the economy is back on its feet. Because injecting money into the economy is only one half of the story. Eventually, that extra liquidity has to be managed. And that's where another important concept enters the picture. Quantitative tightening. If quantitative easing is about opening the tap, quantitative tightening is about slowly turning it back off. If quantitative easing is about increasing the flow of money through the financial system, then quantitative tightening is the process of gradually slowing that flow back down. Imagine filling a bathtub. At first, the tap is open to prevent the water level from becoming dangerously low, but once the tub is nearly full, leaving the tap running indefinitely would eventually cause it to overflow. The solution isn't to pull the plug all at once. It's to slowly reduce the flow until the water reaches a stable level. That's essentially what central banks attempt to do with quantitative tightening, often called QT. Instead of buying large quantities of financial assets, they begin allowing those assets to mature without replacing them, gradually reducing the amount of liquidity circulating throughout the financial system. At the same time, interest rates may remain elevated to discourage excessive borrowing and spending. The objective isn't to stop economic growth. It's to bring demand back into better balance with the economy's ability to produce goods and services. In theory, the process sounds straightforward. In reality, it's one of the most difficult balancing acts in modern economics. Remove liquidity too quickly, and financial markets may become unstable. Credit becomes harder to obtain. Businesses delay investment. Consumers reduce spending. Economic growth slows more than expected. But leave too much liquidity in the system for too long, and inflation can become deeply embedded. Prices continue rising, expectations change, workers demand higher wages, businesses pass those higher costs on to consumers. The inflation cycle becomes increasingly difficult to break. That's why central banking is often compared to steering a massive ship through rough waters. Every adjustment takes time. Every decision carries consequences, and there are no perfect answers, only trade-offs. Looking back, it's easy to point to one policy or one event and say, that's what caused inflation. But the reality is far more complex. Inflation wasn't created overnight, and it won't disappear overnight either. It emerged from years of interconnected decisions involving governments, central banks, businesses, global supply chains, and millions of individual consumers. Understanding those connections changes the way you see every headline about interest rates, inflation reports, or central bank announcements, because behind every percentage point lies a chain of decisions shaping the economy we all live in. And perhaps that's the most valuable lesson of all. The economy isn't driven by one magic switch. It's a living system, one where every action creates another reaction. The more we understand that system, the better prepared we are to make smarter financial decisions for ourselves. Thanks for watching ZK Finance. If you found this documentary valuable, click one of these videos to continue exploring the world of finance, economics, and investing. And don't forget to subscribe, because every great financial decision begins with better understanding. We'll see you in the next documentary.